You would expect for a session on the economic outlook that our speakers would talk about the where we are now, the state of the nation. They'd then go through all of the drivers, the current trends, the policy developments that are then going to give us the prognostications and forecasts at the other end. So that's what you would normally expect of this session. But interestingly, one of those pieces is actually missing. That's the impact of government policy. And that's missing because 16 days after the federal election, we still don't have a government. So it's rather difficult for our economists to assess the impact of government policy. But maybe that doesn't matter. Maybe it's a good thing. Or maybe it's having a dire effect on consumer and business confidence, and our eminent speakers will have to completely rewrite their presentations. But in writing about the outcome of the federal election, this week's Economist magazine says, "The empty and cynical campaigns leave Australia in a mess. Politics that is poisonous, even by Australian standards." I don't know who writes this stuff. "And a dangerous policy vacuum." So what do our two speakers think about that? Does it matter? And what is it going to mean for the economy and for markets? Well, I won't keep you in suspense any longer, and we do need to get back on track in terms of time. So I'd like to introduce to you Shane Oliver. There is a fulsome biography of Shane in your conference program, which I suggest you read. I'm simply going to introduce and welcome him as Head of Investment Strategy and Chief Economist for AMP Capital. Please join with me in welcoming Shane.
Obviously, the period we've just been through has been a very volatile one. We did seem to be on track for a decent recovery up until about April this year. If you recall, the Australian share market got to a high of 5,000. And of course, since then, there's been a whole bunch of things impacting markets. We've had the worries about debt in Europe with the problems in Greece. In fact, I hadn't been to Europe for years, but I thought maybe I should take my family to Greece for a holiday, given things were quite cheap with the strong Australian dollar versus the euro and so on, and try and help the economy out. I don't think it necessarily did much for the Greek economy. I don't think they really cared anyway. But one thing happened, and that is whenever I go away on holiday, share markets seem to take a tumble, and that certainly happened when I was there in late June, only to get back and the share markets have stabilised a little bit. But we've also got worries about Chinese hard landing, obviously a big concern for Australia, a lot of concern about the US, and I think that's the main thing impacting on markets. It's interesting to think about the Australian share market through the 10 trading days post the election. I think maybe the market decided the coalition would win, and that was good news for miners, but there hasn't really been much of an impact to date. And I think the main reason for that is that the big factor driving our market is what is going on in the US, particularly from day to day. A whole bunch of other issues I won't go through. Earlier this year there was the resources tax in Australia, which has since been wound back. Obviously that did cause some concern regarding Australia, and of course the election. My take on the election is that yes, there is potential for uncertainty there, but particularly if we end up with a relatively unstable government, in other words, one heart attack away from a by-election, which could again destroy the balance of power. But by the same token, I don't think the election uncertainty will be enough to destroy the positive fundamentals in Australia, which are driven by our high terms of trade, strong exposure to Asia, and relatively well-managed and well-regulated Australian economy. So yes, there could be some gyrations occasionally, but I don't see the election result being a major disaster for Australia. But all of those things have weighed on markets. Biggest concern, of course, is the double dip worries. And on that front, you have to concede that the risk is greater than normal. The last time we had a double dip in the US was back in the early 1980s, recession in 1980, recovery in 81. Paul Volcker and the Fed back then decided inflation was too high, put the brakes on, and then back into recession in 1982. Very different situation, and you note that the reason they went back into recession back then was because of the monetary tightening by the Fed. This time around, we haven't seen any of that. Obviously, the real issue this time around is the fragility associated with excessive debt levels, both public debt but also the US household sector, where that remains a major factor. So my take is that there is a probability of a return to recession in the US, and I'd probably put it around 35% or thereabouts. But my base case is that we will avoid a return to recession, at least in the next year, albeit we will see very slow growth coming through in the US. Several reasons for that. When you look at the what they call PMIs, or business conditions indicators, which are shown on the chart here, you can see that it's quite normal when you come out of a recession for the PMIs to rebound. So these are surveys of business conditions. They rebound, and then you go through a period where they sort of come off the top a little bit. So if you go back to the early coming out of the early recession early last decade, you saw a similar phenomenon. There was no way they were going to stay as high as they got to, particularly the US ISM index, which is perhaps the most watched economic indicator globally, apart from the payroll figures from the US. So it's quite normal for them to come off the top a little bit, and they're still at levels which is normally associated with reasonable growth. Second reason why I don't see a double dip is that monetary conditions globally are still very easy. So still a lot of cash sloshing around. Yes, the nice if credit growth was a little bit stronger than it has been, but those easy monetary conditions, almost record low mortgage rates in the US, I think will help going forward and help avoid a return to recession. Unlike the situation prior to the last recession in the US a couple of years ago, monetary conditions were actually quite a lot tighter back then. Third reason is that the corporate sector is reasonably strong. So we've seen a lot of comparisons with Japan, people saying that Japan is a good model for the US going forward. I think that certainly Japan is a good model for the US going forward, certainly better than the 1930s experience. I don't see a rerun of what happened in the 1930s, but I also think that the Japanese situation exaggerates the tough time the US will go through. One reason for that is the corporate sector. Unlike the corporate sector 20 years ago in Japan, the corporate sector today in the US and elsewhere is in good shape. Gearing levels are low, and you can see in the chart there that profitability has picked up quite dramatically. If history is any guide, this chart is telling us that sooner or later we'll start to see a fairly decent pickup in jobs growth coming through in the US. And you can also point that out, that private payrolls in the US have been rising. It's the public sector which has been laying workers off lately, and of course we heard on Friday night, and that was because of the ending of the census in the US. But the chart shows, going back to the 1980s, that this sort of strength in profits will result in some boost to employment going forward, which I think provides a bit of an offset to the weakness we're seeing in the public sector and the household sector. Now don't get me wrong, I'm not saying there's going to be a boom in the US and you should shove all your money there. I think it's going to be a long, hard slog for the US coming out of this, but I don't think it's as dire as the markets are occasionally fearing and as many individuals sometimes suggest. Fourth reason why I don't see a double dip relates to China and Brazil and India. That part of the world is very strong. Yes, they're coming off the top, but it's partly by design. China saw a huge rebound in growth on the back of that infrastructure spending. They then decided, well, if we let things go like they are, we'll end up with a boom, inflation, property price inflation or property bubble, and then a bust. So the Chinese authorities rightly tapped the brakes, foot off the accelerator, tapped the brakes, and things are starting to slow down. Radically different to what you're seeing going on in the US. But going forward, my feeling is that China is already slowing. It's not collapsing, but it is already slowing, and I don't see an aggressive tightening in China going forward. In fact, I think the more likely scenario is that China will take its foot off the brake a little bit, and that will enable the continuation of fairly solid growth in China going forward. It's ridiculous to argue that China has overinvested. Per capita income in China is about $5,000 US per person. In Australia, it's something like $45,000 per person. This is per capita GDP. Long way to go to catch up. Those infrastructure needs are massive going forward. And I think that will be a key source of growth in China going forward as that country continues to catch up. In Australia, there's 1 car for every 2 people. In China, there's 1 car for every 50. So huge catch-up potential still existing in China. So similar story in other emerging countries, and I think the key point there is that the emerging world will offset the weakness or the softness we'll see going forward in countries like the US, Japan and Europe. On that front, it's worth noting that if you measure global GDP in terms of purchasing power parity, in other words, value the haircut that I got 2 weeks ago, or maybe so I still need one, but value the haircut I got 2 weeks ago in Avalon on Sydney's northern beaches, the same as one in China. If you probably measure things that way, then you find that the emerging world is slightly more important as a share of global activity than the developed world. Now that's very important going forward because it tells us that you've got to focus a lot more on the emerging world going forward. I think at the moment, according to MSCI World, MSCI World, the benchmark there in emerging shares is somewhere around 15%. Whereas if it's now 50% of world economic activity, then you can see where the opportunities are. But more importantly, the emerging world, I think, will be a much bigger driver of growth, certainly for Australia going forward. Key point there is that the emerging world is not constrained by the debt that is hampering the US, Europe and Japan. And that, I think, means less in the way of structural constraints, much more growth potential going forward. Just moving to Australia. Good news and bad news here. The good news is that the Australian economy came through the downturn very well. A whole bunch of factors behind that, including the government's response, or the quick response in stimulus payments and the lower interest rates and so on, the well-regulated financial system. So I won't dwell on that. You can see there that the blue line, which is GDP growth in Australia, has picked up quite dramatically. In fact, it's 1 quarter out of date because the figures came out last week and I haven't been able to update the chart here. So the blue line has even gone up a notch higher than seen there. So we didn't have the recession many feared a year ago, and we seem to be having a fairly decent recovery. The leading indicator I've put together there includes things like business confidence, consumer confidence, housing approvals, and if you've got a memory for all of those things, you'll know that 2 of the 3 have weakened quite a bit from, say, 6 months ago, and that's what is causing the orange line to roll over. And so it's telling me, yes, we're going to get decent growth going forward, but it's not going to be a boom, which is probably what you want. In that sort of environment, yes, there'll be more interest rate hikes from the Reserve Bank, but I don't see them getting aggressive in putting up rates, and certainly don't see them getting back to previous highs. Now this brings me to inflation. A year ago, a lot of concern about hyperinflation, people saying that America was printing money that will make America the next Zimbabwe with 250 million% inflation like Zimbabwe was having a while back. That, I thought, was absolute nonsense until America uses up its spare capacity and the banks lend out that money that today is still sitting in the bank vaults at the Fed, and credit growth picks up, and then I don't see a pickup in US inflation. In fact, there's so much spare capacity around the world, as indicated below the blue line here, which is a measure of spare capacity in the US, Europe and Japan, still well below zero. That is telling me that the more likely scenario is that the orange line, which is inflation in those 3 regions, is more likely to trend down than up. That in turn means that global interest rates will remain very low going forward, down around the 0 to 1% zone over the next year or maybe 2. So very low interest rate environment going forward. That in turn is good news for shares and other assets, because it means that if you've got very low interest rates, there is this inclination, I think, for investors to think, well, I'm getting such a low return here, maybe I should go into other assets where I can get a better return. If you invest in a well-diversified portfolio of US blue chip stocks, today you'll get a dividend yield well above the bond yield in the US. Similar story in Australia. In fact, it's a more powerful argument in Australia. That brings me to stocks. Several points to note there. This chart shows the performance of shares in the first year after a bear market ends, and then in the second 12 months. So the left-hand side is for the US, right-hand side for Australia, and there the bear market lows. So the most recent low was in March 2009. You can see the average gain in the first 12 months in the US share market after a recession, after a bear market ends, is 39%. In Australia, it's 28%. But in the second 12 months, the average gain in the US is 8% and the average gain in Australia is 6%. So we're going through that tougher, rougher, more difficult period that usually comes after the initial bounce. Shares are no longer dirt cheap like they were 18 months ago. There's talk in some areas, China, Australia of course, of higher interest rates and monetary tightening, and that's weighed. In other areas there's worries about a double dip. You think of Australia back in the early 1990s. Christopher Skase and others had gone on a spending spree building this magnificent hotel, in fact, which I think has benefited Australia in a long-term sense. In fact, we're here using it. But obviously, he borrowed too much money to do that. It almost sent 2 of our top 4 banks bust. We had all the state banks in the southern states go under. In fact, things were so bad, Johnny Farnham had to come out of retirement for, I think, the 4th time to save his old mate, Glenn Wheatley, who got into trouble with Pyramid Building Society, if I recall. So that was our equivalent of what the US is going through now. And similarly, in 1992, you can see it on the chart here, our market had a rough trot, only to recover it, if you remember your history very well in 1993 when it became clear there wasn't going to be a double dip. I think we're going through something just like that right now in the US, and because we always follow the US from day to day, week to week, and sometimes year to year, we're getting dragged along with that as well. Australian shares, very low compared to profits. The blue line here is the level of company profits reported to the taxman, not to the shareholder. So don't forget, when you report to the taxman, you underestimate your profits, unlike when you report to the shareholder, or so I hear. Right now, the share market is the orange line here. I've indexed both to 100, and it's well below the level suggested by profits, suggesting the market is quite cheap. Just on Chinese shares, good story there. Chinese shares are worth tracking, and I've got to speed up here because I'm running out of time. Chinese shares are very important because until a few years ago I think they were irrelevant, but they led at the bottom back in 2008, 2009, bottoming in October 2008, 5 months ahead of global shares, and they also led at the recent top. They peaked in August last year when there was talk of tightening in China, and global shares didn't peak till April this year. So I think you've got to watch Chinese shares very closely. Right now the Chinese share market on a PE basis is very low at levels normally associated with a rebound in Chinese shares. If that's the case, then I think we're in for a better period from the Chinese share market going forward, and hence there'll be a flow on to Australian shares. Commercial property, I think, has bottomed, and you can see the cap rates there turning over, starting to head back down again, and that I think will be good news for superannuation funds that have exposure to directly held commercial property. Housing, very expensive. I don't think it's going to crash because we've got a shortage of the stuff, but affordability is absolutely atrocious. And it's a pity there wasn't more debate about the lack of the poor housing affordability in Australia through the election campaign. But I think that poor affordability will limit the upside in Australian house prices going forward. Aussie dollar just bouncing up and down with commodity prices and the share market, but you can see there has remained reasonably strong. And so hedging, I think, remains an ongoing critical issue. If it looks like we're not going to have a double dip, and I think that will be the case, then the Australian dollar still has more upside going forward. Obviously the world has changed. Key point on that chart, I think, is that the world will be more volatile. Lots more debt in developed countries, greater government involvement in the cycle, and that can give its own volatility going forward. Therefore, we have to focus a lot more on asset allocation. These are some indicative return projections, and the only thing to note that I'll go through in quick detail is that you've got to look for assets which offer decent sustainable yield and/or decent sustainable capital growth, not hampered by debt levels. And on that front, Asian shares, emerging markets, Australian shares, directly held property, listed property and infrastructure stand out as being quite attractive, along with good quality Australian corporate debt. Just summarising all of that, yes, the risks are high. There is a risk of a double dip, but I think the more likely scenario is that we will just avoid it. Next couple of months could be quite volatile, low in markets, but expect a better year through next year. And I think longer term we have to focus more on Asia and emerging markets. Thank you.
Thanks very much, Shane, for that quick sprint through the global and Australian economic outlook. I'd now like to very quickly introduce to you Dr. Chris Probyn. Chris is the Chief Economist for State Street Global Advisors in Boston, and once again, a fulsome biography of Chris is in your booklet. Please join with me in welcoming Chris.
Thank you very much, and let me thank our hosts for inviting me to speak here this morning. If I had spoken to you about 4 months ago, beginning of May, the tone of my presentation would have been far more upbeat. At that point, the global economy was growing quite strongly. If anything, the US was surprising a little to the upside. Japan had come roaring back, almost a V-shaped rebound. And, Europe was doing what Europe usually does, which is lag a little bit. And these kind of developments were being mirrored in market price action. The S&P 500 was up around 1220, and the yield on the US 10-year Treasury note was threatening to push through 4. Signs, if you like, of recovery. And the dollar was offered, suggesting that people were stretching away from the US and looking for risk. Boy, what a difference 4 months make. And what I've been done today is I've entitled the speech Global Transition. And that's for prudish American audiences. For you guys down here in Australia, we can ask the question, what the hell's going wrong? And there seems to be a couple of points I could make. First of all, the global recovery is kind of balanced. About half of it is being driven by the developed world and about half by the developing. That's a positive. However, this is a lackluster recovery, and the risks are clearly skewed to the downside. Let me show you the degree of balance. Here you can see global demand, and these are based upon projections that we've done. And you can see that about half of growth is coming from the advanced economies, and about a little more than half from the emerging world. And that's not dissimilar from what happened during the global boom before. So we have a nice balanced recovery. But look, we can't expect any further improvement next year. We're not getting the kind of global recovery that we saw back in the mid-2000s. You can see a big boom here. The economy, the global economy was expanding almost 5% a year. So in 4 years, the planet expanded by 20%. That's why commodity prices did what they did. Now take a look that after one big bounce back year, moderation already. So what we're seeing is, in terms of economic growth, clearly a disappointment. And it's being mirrored in market price action. What's causing this? Well, Shane mentioned many of the same points. The European debt crisis, we're not going to talk very much about that. It was too short a time today. Secondly, the US economic data have deteriorated markedly. The US economy has made virtually no progress since about April. Flattened right out. Got confirmation of that a week ago. GDP growth revised down to 1.4% annualized in the second quarter. And the third factor is the perceived threat of a policy mistake in China and the possibility of a hard landing of an economy that is key to driving the global recovery. So let's focus on the US briefly. Here you see the pattern of recent US growth. Now, this is the bounce back that we've experienced, and you can see already that growth is tailing off. And if I'd been able to get in last week's release, it would be down here. It would be a good bit below what you're seeing here. Now, in terms of history, there you can see the relative magnitudes. History suggests that the US economy at this point should be flying. We should already be surpassing our old level of output. But we are instead growing at about half speed. What's happened is that the initial blip of recovery in the US is all about inventories. See, demand and production are all lined up. Demand drops, production stays up, inventories build up in the warehouse. They drag production all the way down, not only to meet the new lower level of demand, but to get rid of the inventories. The inventories get into line, production bounces up. We've had that. But the next dynamic is that you're supposed to hand off to final demand. And in particular, consumer spending and housing. Housing's flatlining. There's nothing coming out of housing. And because both of my daughters are studying abroad right now, there is no consumer spending either. But I'm confident about the near future. Another point is that because of this gap between the handoff from inventories and the pickup of demands, unemployment is languishing. The unemployment rate actually ticked up to 9.6% last week. If this continues, we can only assume that we're in danger of trending lower here. So in the great debate that pervades the news wires in the States between inflation and deflation, you have to think about deflation. And that would really complicate the Fed's job big time. Just ask the Bank of Japan. So what we have, I believe, in the United States is a sustainable but thoroughly lackluster recovery with little reason to assume any different anytime soon. Sustainable but lackluster. And I would put the probability of double dip at something around 20%. And that would be predicated upon these final demands not emerging. Now let me move on briefly to China, and here the news is slightly more positive. I do not believe that we're in danger of a hard landing or even a soft landing in China, because the Chinese authorities remain committed to rapid growth. Consequently, my belief is that even though they may have overdone one or two of their policy moves and caused this slowdown which so scared markets, they have plenty of ammunition to turn it around, and when they do turn it around, their economy does tend to respond. So I think we can sort of not worry too much about China. I thought I'd like to end up on a positive note, and that is that of all the economies we monitor, none is doing better than Australia. Let me just show you briefly there. Now, if you compare this recession of yours, well, technically it really wasn't even a recession. This compares to a peak-to-trough decline in the United States of about 4%, about a peak-to-trough decline of about 5% in Europe, and a peak-to-trough decline of almost 9% in Japan. In other words, you guys did great. And your recovery is solid, it is on track, and this doesn't even show the half of it, because this number has been revised up from 0.5 to 0.7, which is 2.8, and you've got another nice 1% in the quarter that was just released last week after I put this presentation together. So your recovery is in great shape. Let me assure you, in the United States, we would kill for a GDP report like yours. So I'm very optimistic about the prospects for Australia. As you can see, we have solid GDP growth forecast for this year. Unlike the US, the unemployment rate is in a solid downtrend. Over the next 5 years, we expect average growth of 3.5%, which is roughly your trend level. And we think inflation is going to settle in the 2 to 3% target range. So I end with just about the only good news that there is out there.
So I think I will kick the questions off. Neither of you mentioned the election, and the policy vacuum that The Economist magazine referred to? Is that because government policy doesn't really matter that much, or you think that the situation will resolve itself? Shane, why don't you go first?
Well, I certainly think the situation will resolve itself, hopefully today in the first instance. But yes, it certainly matters, but perhaps not as much as feared. Obviously, in the short term, we've got this uncertainty as to who will form government, and that might have caused a bit of weakness over and above what Wall Street would have caused. Always hard to find that out precisely. Longer term, I think the real issue to worry about is that in a situation where we've got minority government, there may be less, and this is the thing that worries me a little bit, that we went through a long period in the 1980s and 90s of economic reform in Australia. The last major reform was the GST back in 2000. Since then, it's slowed right down, and consequently, our productivity track record has slowed down. So yes, we've come through the global financial crisis well, and that's all well and good, but if you look under the bonnet a little bit, our productivity track record has slowed right down. Now, neither party, when they went into the campaign, promised much on that front, and you'd have to say that when we have minority government, that there might even be less in the period ahead. So I think that's a bit of a disappointment. It's less likely we'll see visionary nation-building projects going forward. I recently did a tour around the country with Jeff Kennett on that front, and everywhere he went he was complaining about the lack of vision from our politicians, and the taxi driver just drove me up today said exactly the same thing. So I think that's something that concerns me a little bit, and the election has done nothing to help that. It might actually make that situation worse. So that's one thing that worries me, but it's not going to have a major impact on the markets in the short term.
Chris?
I would take the view that the government policy is unlikely to have a big effect upon the cyclical situation here in Australia, which is extremely favourable. I think that obviously it could, but you're getting policy right. You got policy right by being preemptive and aggressive on the way down. You had plenty of ammunition to ease monetary policy, and the cash splash was an appropriate easing of fiscal policy. Your sectors responded in a way that United States sectors are not responding, and essentially much of the hard work has been done. All the Reserve Bank of Australia has to do now is not tighten too much too soon, and they seem to be aware that market interest rates are much closer to neutral than policy rates, and therefore because credit spreads are wide. So I'm very optimistic about the prospects, despite your inabilities here in Australia to put together a majority government.
Thank you, Chris. Questions from the floor?
Phil Kennan, Legal Super. Chris, I take it that you were talking pessimistically, in particular about a lacklustre recovery, US off the boil, European debt, US housing being in a poor state, low US spending, and I was expecting you to say, oh, well, look, I think the chances of a double dip are about 60%. You came back with 20%. I couldn't really, I thought it was a bit of a non sequitur.
He's a fund manager, we're always optimistic.
While I think that the forward-looking indicators that we have, the most forward-looking indicators that we have are pointing at the moment to growth moderation rather than double dip. Now, growth moderation in the United States means that if we see growth in the area of 2.5% or less, that the unemployment rate won't go down, it'll be flat. For as far as Americans would be concerned, this won't be a recovery. But technically a double dip would mean that growth turns negative again. And I'm not seeing any signs in the forward-looking indicators to want to pull that lever yet. So it's a very lackluster recovery with prolonged period of high unemployment, but I do not yet see a negative growth. So we avoid double dip, but it certainly doesn't feel like a recovery.
Please join with me in thanking our speakers again.